Let me introduce myself. I am CA Pravesh Agi. I completed my CA in 1985 and I am working as a visiting faculty with the Institute of Chartered Accountants of India and many management institutes and universities in Delhi and NCR. In today's lecture, we'll be covering capital gains. This is your CA Intermediate course, Paper 4 Taxation, and I am CA Pravesh Agi, professor for this lecture. So let's do question number 2. Mr. Roy, aged 55 years, owned a residential house in Ghaziabad. It was acquired by Mr. Roy on 10th of October 2007 for rupees 24 lakhs. He sold it for rupees 65 lakhs on 4th of November 2017. The Stamp Valuation Authority of the state fixed the value of the property at rupees 72 lakhs. The assessee paid 2% of the sale consideration as brokerage on the sale of the said property. Mr. Roy acquired a residential house property at Kolkata on 10th of December 2017 for rupees 7 lakhs and deposited rupees 3 lakh on 10th of April 2018 and rupees 5 lakhs on 15th of June 2018 in the capital gains bond of Rural Electrification Corporation Limited. He deposited rupees 4 lakhs on 6th of July 2018 and rupees 9 lakhs on 1st of November 2018 in the capital gain deposit scheme in a nationalized bank for construction of an additional floor on the residential house property in Kolkata. Compute the capital gain chargeable to tax for the assessment year 2018-19 and the income tax chargeable thereon, assuming Mr. Roy has no other income. Now, the cost of inflation index for the financial year 2007-8 is 129 and for financial year 2017-18 it is 272. Now, let's answer this question. We will compute the capital gains chargeable to tax for Mr. Roy for the assessment year 2018-19. As it is given in the question that Mr. Roy has sold his property for rupees 65 lakhs on 4th of November 2017. But the Stamp Valuation Authority of the state has fixed the value of the property at rupees 72 lakhs. Here we will be taking the gross sale consideration as 72 lakhs because as per section 50C, if the consideration for transfer of the house is less than the value adopted by the authority of the state government for registration of deed for the purpose of stamp duty, the value adopted by such authority shall be deemed as full consideration. So on this basis, we will be taking the gross sale consideration as rupees 72 lakhs. Now he will be allowed an expenditure on account of brokerage at the rate of 2% of the actual sale consideration of rupees 65 lakhs, so which comes to 1,30,000. So the net sale consideration would be 72 lakhs minus 1,30,000, so which comes to 70 lakhs 70,000. Now he will be allowed an indexation benefit. An indexation benefit has been computed. Now in the question it has been given that the cost of inflation index for the financial year 2007-2008 was 129 and for the financial year 2017-18 it was 272. So while we give him the indexation benefit, so it will be 24 lakhs into 272 divided by 129, so which comes to 50 lakhs 60,465. So the long-term capital gain would be 70 lakhs 70,000 minus 50 lakhs 60,465, so which comes to 20 lakhs 9,535. Be also eligible exemption under section 54, which says that one residential house in India should be purchased within 2 years after the date of transfer. So he acquired a residential house at Kolkata on 10th of December 2017 for rupees 7 lakh. So which is within the prescribed time of 2 years from 4th of November 2017 being the date of transfer of the house at Ghaziabad. So he will be eligible for an exemption of 7 lakhs. Further, he deposited rupees 4 lakhs on 6th of July 2018 in a capital gain account scheme. That is also within time, because deposit in the capital gain account scheme should be made before the due date of filing of the return of income. And this has been used for construction of additional floor on residential house property at Kolkata. So Mr. Roy has no further income and his due date for filing the return is 31st July 2018. Hence, 4 lakh deposited on 6th of July 2018 will be eligible for exemption, whereas rupees 9 lakhs deposited on 1st of November 2018 will not be eligible for the exemption under section 54. So he'll be allowed exemption of 4 lakhs. So overall the exemptions would amount to rupees 11 lakhs. Now he will be also eligible for exemption under section 54 EC, which says that the capital gain arising from the transfer should be invested in a long-term specified assets within 6 months from the date of transfer. So he deposited rupees 3 lakh on 10th of April 2018 in the capital gains bond of the REC Limited within 6 months from the date of transfer, that is on or before 3rd of May 2018. So this would qualify for exemption. Hence in this case 3 lakh deposited in capital gains bond on 10th of April 2018 would be eligible for exemption under section 54 EC, whereas rupees 5 lakhs deposited on 15th of June 2018 would not qualify for exemption. So the exemption would be limited only up to 3 lakhs, which was within the time period. So the long-term capital gains then would be 20 lakhs 9,535 minus 7 lakhs minus 4 lakhs and minus 3 lakhs. So that comes to long-term capital gain of 6 lakh 9,535. So which can be rounded off to 6 lakh 9,540. Now let us compute the tax liability of Mr. Roy for the assessment year 2018. Now the tax on 3 lakhs 59,540, because the long-term capital gain here is 6 lakh 9,540 less the basic exemption limit of 2 lakh 50,000. So tax will be calculated on rupees 3 lakh 59,540. And this will be chargeable at the rate of 20% as per section 112. So it comes to 71,908. Since he does not have any other income, the entire basic exemption limit can be exhausted against the long-term capital gain. So that's what we have done here. Now there will be an education cess of 2% and secondary higher education cess of 1%. So that comes to 2,157. So his total tax liability would be 74,065 rupees, which can be rounded off to 74,070 rupees. Hope you all enjoyed the lecture as much as I did presenting for you. Do add your comments, as it is very encouraging and motivating. Please do like and do subscribe. Thank you.